Many people in this industry think that these two jobs are super sexy right now with private equity in the lead. And the question is why, right? Why are these jobs so prestigious and desirable? Well, listen, first of all, it's the fact that you have exactly the opportunity to potentially make a lot of money. And we're not talking, just to give you guys a sense of scale, we're talking 7, 8, 9-figure type of money at the highest echelons.
Yep.
Okay. So you could be making over $1 million by the age of 25, potentially, depending on who you are and what your role is and what firm you've landed at. The allure of that kind of money is pretty much reserved for what? Elite athletes who need to have the kind of gift that you can't learn, right?
Or actors or Kim Kardashian.
Entrepreneurs out there who are trying to get a lotto ticket, right? By having the great idea and a great company and have some kind of exit path for that. But man, that is a totally different lifestyle. No one is laying a groundwork for you. There is no apprenticeship model in entrepreneurship. Like, you better have the next WhatsApp or whatever it is.
Yeah.
The private equity and hedge fund space, we're talking about an opportunity to make a ton of money very quickly. And you're also at the top of the food chain, especially within the financial services industry. I mean, we've talked about with all the different divisions of a bank, the commercial bank, investment bank, you've got the investment banking division, the capital markets division, sales and trading division, prime brokerage, which we haven't even touched on, research. For all of these different divisions, if you are at a private equity firm or a hedge fund, you are the client, okay? You're the one getting taken out to dinner. Everyone's fawning all over you. Everyone is working for you. You don't have to answer to anybody except for your investors.
Right.
And that's really, really nice. It is nice to be the shark at the top of the food chain. Just a quick recap, right?
Yes.
So a private equity firm is a pool of capital that is used to make investments in companies, okay? They invest in those companies, usually buying a controlling stake in them. They typically restructure them in some way to make them more valuable, and then they sell them down the road at a profit.
And I want to jump in because there's actually even like 2 buckets of private equity firms. You have the growth equity, which people often think of as private equity as well. I mean, it is, where these are funds that are investing in earlier stage companies, right? These are not investing in like dinosaurs. They're actually kind of like on like later stage venture capital, right? So they're earlier in the growth trajectory. The point is that the investment you're doing in growth equity is going to look a little bit different than what we think of as like the more classic leverage buyout strategy, the more classic private equity model, which is where you buy a company primarily funded with debt, and you go in and you make a lot of changes to the operations. Like working in private equity, you are actually changing the company. You're working on cutting costs.
With Dewey in Succession, right? Like you're involved, right? You're getting your hands dirty. Okay,
Exactly.
but a hedge fund, by comparison, now that's a pool of capital as well. They can invest that money based on whatever their particular strategy is, but hedge funds can have all different kinds of strategies. So you've got equity long short hedge funds, which are like the classic hedge fund that a lot of people outside of the markets know about, global macro hedge funds, which express a view on, we call it global for a reason, right? Huge global themes. Like, what do you think of the US versus China? Not what do you think of bond A versus bond B? There's relative value hedge funds. You've got credit-based hedge funds. You've got convertible arbitrage hedge funds. And then keep in mind that hedge funds, they can invest not only in pretty much anything, but they can also invest in companies, just like private equity firms can, either through the global equity markets or as activist investors in individual companies. But the chief difference that we actually think of between a private equity firm and a hedge fund is their investment horizon, meaning the timeline for their investment. So hedge funds are typically evaluated on their annual return, okay? And that's usually the product of some shorter term trades where they're in and out of the markets, and some longer term trades which are being marked to market for kind of their current market value. All right. A private equity firm, they're going to invest with a much longer horizon. It's typically 5 years, 5 to 7 years. It can be longer depending on the scope of the investment.
Which makes sense because they're buying the company and they're trying to change the business. So that takes time to do, right? It takes time to implement if you are
changing strategy.
Right.
So there's a lot of other differences that we will get into some of those in more detail.
Well, I was going to say, because of that different time horizon, it actually creates some other kind of unique things that actually make just the business model, like if you work in private equity, you're set up for success a little bit better.
So I think we should now dive into, so how the heck do you break into this and what's your path right?
So if you want to break into private equity and your goal is to go work at like the mega funds, the most prestigious, you basically need to know what you want to do as like a freshman in college. And why do you need to know that? So the reason you need to know that is because, as you've said before, and I think it's disappointing that this is the case, but unfortunately is if you want to get to the most prestigious, you are going to be
the mega funds.
The mega funds.
Yeah. And how many mega funds, quote unquote, would you say there are? 10?
When I was working at Morgan Stanley, I feel like we covered all the mega funds. I'd have to sit down and like look at a list. I probably should know because they
So we're talking about getting into the top 10 most prestigious.
Blackstone, KKR, Vegas. Carlyle, Apollo.
Mm-hmm. And to be clear, this is not an exhaustive list of all the private equity firms out there.
No.
These are the ones.
Tons of private equity firms.
Right.
Yes.
And these are the ones that you need to know at infancy that you want to join.
Right.
This is not saying this is the only path into private equity, but we're starting with these big guys because they have the most rigorous recruiting process.
Right. The places that these private equity firms are going to be recruiting from are your bulge bracket. So like your Morgan Stanley, your JP Morgan, your Goldman Sachs, and your elite boutiques. So like the Lazards, the Evercores, but then also from consulting. Why do they like consulting? Well, remember back to what we said, you're ultimately doing. You are fixing businesses. What do consultants do? They fix businesses. Right. Yeah. So they do tend to like that. Now, if you are in, say, like an M&A group, if you are in the financial sponsors group, leverage finance in capital markets, depending on what you're doing, those are also going to be extra credit. And also, I mean, like they'd want the people that went to the top schools.
You have basically a matrix to think about. It's what's your quote unquote pedigree, meaning what is your educational background? Now, what work experience do you have? Even though it's not real work, it's internships.
Right. Because to put this in context a little bit, the on-cycle recruiting this year, it started before people, and some had gone through training. Many had not even gone through training. So you have someone who just graduated from college. They have an offer. They're going to work in investment banking for 2 years. And before they've even hit the desk, like I thought it was crazy when they started to push it so far that you hadn't had a performance review. Now it's before people hit the desk. You are now being asked to go through the interview process for these private equity jobs that aren't going to start for 2 years. You're not going to have deal experience aside from what you did in your internship.
Unproven product, but you are being evaluated almost exclusively on the line items on your resume. So many people ask us about breaking into the industry or whatever. These are the things that are not easy to break into, unfortunately, at least at these mega funds.
Right.
We have spoken to a number of you who have non-traditional backgrounds who are working at private equity funds. There is a path, but the door to these mega funds may be closed to you if you don't have the quote unquote right boxes checked on your resume. And that's devastating to me.
And I want to also touch on that too, because if you want to work in private equity, your only option is not just Blackstone or KKR. There are tons of private equity firms. And Jen and I were talking about this. Like,
there are a dime a dozen in Charlotte.
One of my good friends just started a private equity fund. Like there's lots of firms that are out there. It's not just these elite ones. But a lot of people, when they say I want to go work in private equity, this is oftentimes what they mean.
The reality is they want that asymmetrical upside.
Yes.
The highest likelihood of that asymmetrical upside in the current environment in 2023 is working for one of these mega funds. However, that doesn't mean that you couldn't go to a smaller fund that isn't located in New York or that is located in New York. It could be located anywhere and have a huge multi-million-dollar payday. And you don't have to go through this nonsensical recruiting cycle.
I'm going to back up and say one more thing, that a lot of times people will say like, can I get an MBA and then go into private equity? And the answer is usually no. Unlike with investment banking, where there is formal recruiting out of an MBA program, what happens in private equity, you do 2 years as an analyst, you go 2 years private equity.
This is the mega funds.
Yeah. They will then pay for you to go back to business school, and then you come back and you work in private equity. And so they are not going to be hiring someone out of an MBA class that doesn't have the prior experience in private equity.
You got to have something. Yeah.
Usually you actually need the private equity experience coming out of an MBA. So anyway, that just goes back to what we said before, which is like, you basically need to know as an infant that you want to go into private equity, which is very unfortunate because a lot of people don't. Hedge funds, there's more opportunities to get in. And so because there's lots of different strategies, so you could go into sales and trading and then come out and go work at a hedge fund.
And by the way, when you say sales and trading, it doesn't just mean trading.
Right.
So many of the most successful people that I know at hedge funds started in sales. So you don't have to follow this really, really narrow path to go to the buy side at a hedge fund.
Right. To Jen's point, if you end up at the right hedge fund, you're making over $1 million.
And let's talk about right hedge fund, right? So there's a number of different ways that you get paid at a hedge fund.
Yes,
there's a number of different ways that you get paid in private equity.
Right.
But generally speaking, the biggest difference between the way you get paid at a hedge fund and the way you're going to get paid at private equity is determined by how much you individually contribute.
Right.
So at a hedge fund, if you are, let's say, a young portfolio manager, most hedge funds aren't going to say, here's $1 billion, go knock yourself out and see how it goes, right? They'll start you with a small pool of capital, and then they'll move you up based on your proven results.
Yep.
But if you are very, very good, you can sometimes take a small pool of capital and make a lot of money.
Right.
And so they trust you more and you have proven results, and then they give you more and more and more capital, right? They'll give you as much rope as you want to hang yourself with,
right,
as long as you keep proving that you can make that money grow.
Yep.
At a private equity firm, it's less about an individual's contribution to the bottom line. So there's a much more flat pay structure there, if you will, versus the outsized pay structure for an individual that can happen within a hedge fund. But
right.
Either way, either a hedge fund or a private equity firm has to have a great year in order for you to get paid that huge, big payday. So if you're the best trader at a hedge fund that blows up, it doesn't really matter, right?
Yes.
If you're the best deal maker at a private equity firm that can't get a deal done, it doesn't matter, okay?
Right.
But if you're at a hedge fund that's doing well, and you are a great trader, great portfolio manager, great research analyst who's coming up with the best trades, awesome. Sky's the limit for you. So that's the distinction I wanted to make there when you talk about going to the right fund. That fund doesn't have to be a super fund. That fund doesn't have to be one of a select few.
It was funny because when we were talking to Paul on the What is a Hedge Fund episode, who, by the way, if you haven't listened, this is someone who worked at Bridgewater, which is currently the largest fund in the world, and by assets under management. And he was like, yeah, when I started, it was, Ray Dalio wasn't doing that well. Like it wasn't what it became. And so you can go to a fund that doesn't have as much assets under management, but then happens to be at the right strategy and the right time, and you can obviously kill it. And we're going to also talk a little more later about like right time, because private equity in the last 15 years, right place, right time, right? So how else can you get into a hedge fund? So there are different roles at hedge funds. You could be on the investor relations or marketing side, where you are the person going out raising the capital. You could be working.
And by the way, managing those same people, right? Again, these are the only people that you report to are your investors. You're also managing those relationships when the fund isn't doing that well. So there's a little bit of that too.
Yes. So there's obviously these different roles, right? So the investor relations side, more like the business development side. And then you have, right, the research analysts and the portfolio managers. So it can vary like how you get from point A, which is if you ultimately want to be a portfolio manager. Jen and I were talking about this, that coming from the trading side, if someone is a really good trader at a bank, they can get hired as a portfolio manager, like directly from the sell side.
Right.
That is not really as common if you're coming out of IBD. A lot of times you're going to be hired and you're going to start and you're going to go in as a research analyst. Who is supporting a portfolio manager. And then if you are constantly coming up with these best ideas, then you will be promoted to portfolio manager. The distinction between research analyst and portfolio manager, I mean, there are some funds where there's only one portfolio manager and you are always a research analyst. So these titles can vary fund to fund, but out of investment banking, you're probably going to be going into more of a equity long short type fund, whereas out of sales and trading,
because you're an expert in studying
you're an expert in analyzing these companies, studying these companies, and coming up with what you think the valuation is. And so that's why equity long short is like where you will ultimately go. And then we obviously spoke with Steve Haggerty on a prior episode talking about equity research. It is not as common to go to a hedge fund if you are in research, which I was joking with Steve. I was like, it's kind of counterintuitive because you are actually the one who is like doing a lot of these analyses, and the bankers steal what research does a lot. But as he put it, if you're working in research on the sell side, your focus is much more marketing oriented. And so you're not so much someone who is like taking risk. And so it's a different skill set. So if you are further along in your career, it can be a lot harder. Steve did it, but it can be definitely a lot harder.
You can make the switch, but you'd have to be the one driving the bus and showing a hedge fund why you aren't just another sell side research analyst, because they're going to want to break down how you've been taught to work and teach you how to work in a very
And actually, Jen, did I ever tell you this? When I was teaching a class, this was like 5 or 10 years ago, I actually had someone who came to my class because they wanted to hire someone at my firm, because they're like, well, these people are clearly great at building models. And so the guy, he was the COO of that firm, which is a very good firm. And he was like, oh, are you interested? So that was the point of the story, is that you can have non-traditional ways to get in.
Teaching into a hedge fund. At a hedge fund, you kind of eat what you kill.
Yes.
Right?
Yeah.
It is all performance-based. So if you can demonstrate skill, great. They'll take a chance on you, or they're much more likely to take a chance on you. Now, actually going through the interview process, certainly if you want,
it's a rigorous interview process,
right?
Yeah,
it'll differ, but you'll likely be asked to construct a sample portfolio, explain your
if you're on the
scenario analyses on the portfolio management side, and talk about that versus.
Equity long short
research side.
Well, if you are coming out of investment banking, going to say an equity long short fund, they're going to probably send you some financials. They're going to ask you to look at the financials, write an investment thesis, build a model. You're proving that you can analyze a company.
But they're just going to ask you about one company versus building a portfolio of, say, 20 companies.
I want to make sure that you understand that you can come up with a thesis on this company. At what price would you buy? At what price would you sell? What is your time horizon? What are some things that could obviously impact the value? So they want to see how you think about a particular company. And so the point is, it's usually like there's almost like a take-home exam, right? And there could be a modeling test. Private equity, you're often going to be asked to build an LBO on the spot. But look, all hedge funds are different. They all recruit different.
And by the way, hedge funds employ headhunters who are floating
as
around.
do private equity firms. So,
and we're going to bring a headhunter on the podcast,
we need,
guys, so you can get insight into that process.
And I will add, just because you're working at a hedge fund doesn't mean you're going to make more than you would make working on the sell side. Because it depends. It depends on the performance of the funds.
Exactly.
So at the end of the day, I mean, like working at a hedge fund is not necessarily going to be like the end all be all, and you might decide that you would do better going back on the sell side. But
or again, if your fund blows up or you don't have a good year, whatever, you can read the writing on the wall. Yeah. You can take that prestige and clout and proven track record and go back to the sell side and say, hey, I'd be great at XYZ here. And then after a few years, go through the whole process again. Whereas there's far less cross-pollination between the private equity realm and the sell side in terms of people going back to the sell side. I think your fund would probably have to blow up. And
right.
That's not that common these days in the private equity space. And let's talk about that. Why? Let's talk about the relative trade-offs between private equity and hedge funds.
All right. So let's talk about private equity fund versus a hedge fund, because at the end of the day, this is one thing that right now private equity has a little bit of an edge for a couple of very structural reasons. So first of all, both funds are going to have that 2 and 20 type of model. And so what that means is that if you raise $1 billion, 2% of that is going in your pocket every year just to manage the money. Now, the way though that these funds make the killing is because if you turn that $1 billion into $3 billion, you are going to get 20% of the upside. So 20% of the $2 billion. That is yours for that performance. So that's how they make all of the money. Now, because the last 15 years, since 2008, it has been low interest rates. I mean, rates were
bull market.
0%.
Equities are up,
which means equity is up. Yeah. But that means now you have, because it is so cheap to borrow, that is also fueling valuations of equity. And by the way, you were in private equity. If you were able to, it would be like levering up a home. Like you're going to buy a house, and we've been the last few years, like the value of houses have gone crazy.
Right? We've been in a low interest rate environment, and home prices have gone through the roof.
Exactly.
Right?
So
it's the same way.
Exactly. So in the last 15 years, if you were in private equity, like you've been killing it, because the value of these companies are going up and you are borrowing for free, you're levering it up, and now you have just made a shit ton of money. that is not necessarily going to be the case in the future, right? Rates have gone up. We were talking with Brian about like this inverted yield, like is there going to be a recession?
Sorry,
like
just to talk to you, what we're talking about here, we're going to be airing an interview with Brian Weinstein, who now runs fixed income at Morgan Stanley Investment Management. So we were talking about the shape of the yield curve with him. That's something that if you don't understand now, hopefully you'll understand after that episode. But sorry, just so we're
yes, and the fact that there is this inverted yield curve essentially signals, I mean, great to look that the market is not a oracle, but it usually signals that there is going to be a recession. So that is the expectation.
And that rates will go down in the future.
Right. They will go down because there is a recession in the future. So the Fed will have to lower rates. But the point of this is just that rates are up, which means that theoretically the value of your equities like should come down. And there's also possibility of a recession.
That's exactly right. Yes. And it's more expensive to borrow money.
It's more expensive to borrow money. So again, it means that it's going to eat into the returns. And actually, this is something that we didn't talk about, but I'm just going to throw it out there. In the 2017 tax change, there actually was a change in the way that interest is deducted. And so you actually, some LD, like depending on how much debt you take on, you might have to pay tax on your interest. I want to say, so back to the 2 and 20 though, because hedge funds over the last 15 years, they haven't necessarily done as well. They haven't just been like levered long the equity market. There's lots of different strategies. They are paid, by the way, in many cases to not be correlated to the market. And so not all funds have done that well, which means that they have had to compress fees. Whereas private equity, they have not because their performance has been much better. Again, makes sense. You're levered long a bull market with zero interest rates. So the fees are potentially a little bit different. So the private equities more maybe your 2 and 20, and hedge funds is maybe now like less.
It depends on the fund.
It totally depends on the fund. And there's different products at funds where they have different fees, but the fees are potentially a little lower at hedge funds. Not always. If you are
but private
Citadel,
equity has not really been subject to fee compression because everyone's making money hand over fist pretty much without exception.
Yes.
If you haven't made money at a private equity firm in the past 15 years, let me put it this way, you're doing it wrong.
Right.
I mean, don't get me wrong. It's not like I could do it, but.
Oh, me neither. Actually, me neither.
I'm not cut out for this stuff.
Me neither.
Sorry. Yeah, no, let's be clear. We sound like we're getting like super snooty here. No, I could not do this.
I could not do this either. So we talked about fees and how private equity has potentially a little bit of an edge just given the performance of the past, call it 15 years. So the second thing is in 2000, I think it was 2017 that this happened, but there's something called this carried interest loophole. Now, what is that? So back to the 2 and 20 that we talked about, right? 2% of assets that you make the fees, 2% of, call it the $1 billion, and then you get 20% of that $2 billion if you go from $1 to $3 billion. So there was this quote unquote loophole, it's a tax loophole that said essentially that $2 billion of money you made, you get to pay long-term capital gains on it, which is lower than ordinary income. So if you are a partner at a private equity firm and you've made like this $2 billion, because it's usually, by the way, it's going to go to the partners.
It's their income.
Right. It becomes their income. And so they don't have to pay the like 50% tax bill. They're paying, call it 15% or whatever long-term capital gains. Maybe it's 20% out. Now in I think it was 2017, they closed that loophole for investments. I think that was like less than 3 years. And so that basically is most hedge funds. 2 years. Okay. The point is that essentially if you are investing the way a hedge fund does, you now do not get to take advantage of that tax loophole. In the Inflation Reduction Act, they tried to close it for private equity too, because private equity, they have this like 5-year time horizon. They get to do that deduction and they tried to close that loophole. So that was last year. I think it was Kristen Sinema, who was like the Arizona senator. For whatever reason, like that was the hill she was going to die on. It was like, you will not close this loophole. So it is still alive and well, right? It is still, if you work at a private equity shop, you still can basically, your tax rate is that long-term capital gains, not ordinary income. So a partner at a private equity firm who's getting that money, like they're going to pay a lower tax rate. Now, the third thing is we talk about liquidity and lockups when it comes to the structure of these funds. So
people's investments.
Right. So if you are
not the investments that the fund is making.
Right. Not the funds. This is the limited partners
fund and you are giving your money to a private equity firm versus a hedge fund.
You have
a different lockup.
Exactly. You are a super wealthy individual. You are making millions and millions of dollars. And you say, you know what? I need to invest my money. I want to invest it with a private equity firm. Great. You are going to now lock up your capital And by the way,
touch that money no
you
matter
can't
what
touch,
happens to
yeah,
it, no matter what they do with it.
Yes, because they're buying companies. And they can't just have people pull that money out just because, oh, my kid's going to college, I need it back. I need my money back. With a hedge fund, the lockup periods are different. Hedge funds can vary. Different funds have different lockups. They can have wildly different lockups, but they're probably not going to have a lockup for 10 years that your private equity firm is. And so the lockups can be, they could be daily. You could decide, I want to pull my money out today. Great, right?
Most funds, I would say, are somewhere between daily and 1 year as far as how long it's going to, if you really decide that you want to make a redemption, you likely will be able to get your money out in the span of a few months. Maybe not all of it, but at least some portion of it. It just depends.
So, but the point is it varies. And what that also means is that there's bad performance in a hedge fund and you're like, oh, this looks like it's not doing well. I want to pull my money out. That hedge fund's assets under management could go from 5 to $1 billion, right?
Right. You'll have the compounded impact of both lower returns, that overall pile of money shrinking as it loses money, and then the knock-on effect of people losing confidence and withdrawing their money. We've talked about runs on the bank before.
Yeah, it's
hedge
the same
funds
idea.
go through runs on the bank.
So that's why you might hear, and that's why you might hear the fund blew up. And you could have an investment strategy where, like, maybe they've made all the right bets. There's been a dip in the market, and if they'd held on for longer, it could have recovered and done great. But if you have people pulling their money out before then, it doesn't matter. You're not going to stay around long enough. Like that was like the long-term capital management. If anyone's read that book, right?
Right.
So.
Was that When Genius Failed? Was that what the book was called? When Genius Failed.
When Genius Failed.
Just in case anyone does want to read it.
Yeah. So that is another difference between private equity versus hedge fund. It does mean that if you work in private equity and the fund structure set up that way, you have longer longevity and like you can potentially
even if you're
withstand
crappy,
down.
You stick around.
Versus people can't get money back.
Yeah, you got to pay the piper, and there's a lot more accountability at hedge funds for performance. It's much more performance based.
Well, and also though, you could see the performance, right? If you're investing in private equity,
transparency.
These are private companies. I mean, you don't know what the value of that like business that they bought is.
They can say it is whatever they want it to be. I mean, that's not true. I mean, there are independent business valuation experts who literally do this for a living. They will come and tell you what the mark-to-market valuation of a private company that doesn't trade is. But I mean,
but again, there's subjectivity there. I mean, you could look
so much subjectivity.
Yeah, like you make the assumptions, like, oh, this discount rate for my DCF. Would we lower the discount rate a little bit? Look, that valuation looks a little bit better.
It all works in the favor of private equity firms right now. It really does.
Yeah,
it means that they hold on to money longer, right, and they're less subject to the whims of their investors. We said it before; they are the only people that these funds answer to. Yep. So if you have the most favorable structure with respect to your investors, that's going to work in your favor.
Right. So those are all things that obviously are in the pro private equity column. As we said, there could be a change with the carried interest loophole that could close. You never know.
By the way, the sexy thing to do when we both started in the business was to be a prop trader at a bank.
Right.
You know any prop traders at banks these days? Oh, no.
They're not. Right. They were regulated out of existence.
Illegal. Exactly.
Yes.
So you get on the wrong side of politicians, whatever it may be, public perception. And let's talk about public perception a little bit too, because I think that talking about that shift brings up another good point, which is back in 2007, 2006, when we first started in the business, hedge funds were like, again, they were the big sexy thing out there. Trading at a bank was the big sexy thing out there. And then the world blew up in 2008. There were legitimate things that went wrong, but public perception turned against trading at hedge funds and at banks and has never really turned back in a favorable light.
Right.
What's funny is that if you look at what a private equity firm does, right? They go into your
mom and pop
company ABC, but they go into a company that you may know and love, right? And they rip it to shreds. They cut headcount most likely. They may cut benefits. They change how the thing is run. Their goal is just getting the last possible dollar squeezed out of that company.
Right.
And listen, that is all perfectly legal, right?
Mm-hmm.
But in an environment where everyone is much more, I think, ethically charged and sensitive these days, private equity isn't exactly going out and,
making the lives of the people who work at these businesses better. I'll put it that way. It is not, that is not what it is doing.
Right. So if you work at a company that's been taken over by a private equity fund, chances are you don't love your new overlords, right? And I think that nobody really talks about
that. I know, it's
the
funny.
same way that hedge funds and bankers are vilified. I mean, if we're going to vilify one, vilify them all, right?
With a private equity firm, this is their investment, right?
Yeah.
They buy the company, and if you think about what they're trying to grow, it's EBITDA. What is EBITDA? Revenues minus costs. Well, whose costs are those? The salaries of employees, right? And so
that's one of the big
way
costs.
The way that they get valuations up is cutting costs. And so if you are the person who is at the private equity firm and making these decisions, it actually has consequences for the lives of people who are on the other side. And I don't think people think about that. It's funny.
For whatever reason, it's just not part of the public discourse in the same way that people who are in and out of the markets all day long are. As far as,
because if you're at a hedge fund and you're just like making bets on and again, I want to be very clear. What happens to a company's share price can absolutely have effects on individual people, like massive effects, right?
Yeah.
So if you are shorting the crap out of a stock,
I was working
right? You're working at
Lehman, where Greenlight Capital decided to, exact vengeance upon us for a bad meeting with Aaron Callan.
Exactly. So it's not like you're not
on both sides of it.
Yes, exactly. So that brings us to one more point, and Jen, we had spoken about this a little bit too, which is a couple of things, right? There is the lifestyle, and like, are you going to actually like what you're doing? And the test,
everyone wants these jobs, but do you
like it? Are you going to like it? Is it right for your skill set? Right. And so the test that I was talking to my husband, and he was like, the test that I always heard, and actually I had heard this, but it was more for investment banking versus sales and trading, but he was like, for private equity versus like a hedge fund, if you are opening up the Wall Street Journal, are you going to the market section? Are you like, is the fast pace of what's happening day to day and like the movements and all that is that intriguing to you? Or is it the story? Are you going to the business section? And are you more interested in the story of the business? And I think that's a really important question to ask. Also, are you someone who wants to be making deals, or do you want to just decide, you know what, I like this investment, let's do it, right? Do you want to be able to pull the trigger? Because
how comfortable are you with risk? Right. I think that's another thing. And people don't think about this all the time when thinking about themselves and evaluating their personality and their intellect. But how comfortable are you with taking risk, with saying, this is my view, I'm going to go express it, and there's money on the line, and there's personal credibility on the line, and there's my job on the line, right?
And by the way, you could get it wrong for a reason that was not your quote unquote fault. You could have, decided
the right trade at the wrong time is
if
the
you
wrong
shorted
trade.
GameStop, if you short a GameStop, you're like, this company,
they're
the
making
fundamentals.
a movie about that?
Are they really?
Yeah,
but no,
I'm actually really excited to see it. It looks good.
I totally want to see it too. But no, you decide you're looking at the fundamentals. You're like, GameStop, that the valuation, the fundamentals don't make sense. I'm going to short this thing, and all of a sudden it's like a meme stock, and you're just like, what happened, right? Like, it doesn't matter that you were quote unquote right.
Right. Yeah.
Like
you
COVID,
have to be really humble. There's just a lot of discipline, mental and emotional, that goes into taking risk.
And how are you going to feel about losing a shit ton of money? Because it's going to happen. You're not always going to pick winners. How does that feel? Are you okay with that?
Yep.
Back to just like private equity versus like a hedge fund, you are doing deals. Like, you actually have to get in there. You have to change the companies. And if you are at a hedge fund, you do have to be comfortable with the risk taking. You don't have to like get in there and do as much of like the dirty work.
So some portfolio managers never touch the market. They will send down a decision, and
your ivory tower,
up from your castle on the hill, a little piece of paper floats down to the traders and says buy or sell.
Yeah.
And then it's up to the traders, and they'll say, I care at these levels, blah, blah, blah. It's up to the traders to actually do the physical act of purchasing or selling something, of getting the trade on the books, right? And depending on the scope of the trade, it could be, hey, you've got this much bandwidth in which to do it. Or it could be, if you don't get this done in this infinitesimally small margin, the trade doesn't make sense.
Well, that was exactly what Steve Haggerty was saying in our conversation with him. He's like, I would see like these portfolio managers like sitting over the trader's shoulder, like hit that. Because if you don't hit it at the right price, like now all of a sudden that trade, to your point, doesn't make sense anymore.
Why doesn't the PM just do it himself at that point? He's got a Bloomberg.
I guess.
But no, you're right. Absolutely. So execution and strategy rather go hand in hand. They are just opposite sides of the same coin, right? You could have the most brilliant idea, but if you can't pull it off, it doesn't matter, right? So one of the things that we were talking about that we kind of got sidetracked on there is, how do you know what's right for you? So is it the deal making versus the deal frequency, I guess?
Yeah.
Like, is it the nitty gritty? You talked about legal documents. That is not something to gloss over. Like the amount of paperwork that you are going to go through in your due diligence process, in the actual process of executing a deal at a private equity firm. Like there is just a lot of tiny minutia and detail about this one trade. You are going to know this trade better than you know your spouse, better than you know your kids, because you're going to be living and breathing this one deal in this one company. At a hedge fund, regardless of the strategy, you're going to know much more about a broader spectrum of things, whether it be a broader spectrum of companies. Because again, even if you're an equity long short fund, you're not going to be trading one stock long and short as your entire position. There's going to be at least more than one stock.
Right.
And so,
and the doc, I mean, you're granted, we've said this before, there's a lot of convergence between hedge funds and private equity. Is there a situation where you could be making an investment in a small business and like there is some kind of legal, sure.
But, I'm not saying like you'll never see a legal document in your 100%.
Life. Right. And if you are on the credit side, you might need to understand the organizational structure, because it matters, like whether the bonds were issued at the holding company or the operating company. Like these are like little things that's more of like a distressed situation, but depending on the type of investments you're making, sure, you might need to get into documents.
You need to know a lot about that company, almost as much as you'd need to know if you were buying the stock, right? It's just you need to know a different set of facts.
Right. And the amount of legal documents that you are potentially, and the deal making, you're going to have more of that with private equity. Do you like that? And ask yourself, really though, but like, really, do you?
Talk about like this big distinction between, even we've talked about this a lot, between the two kind of halves of the bank in terms of, do you like a project-based lifestyle or do you like something more fast-paced, right? And that sounds like such a silly thing, because at any given point in your life, you might feel inclined towards either, right?
Right. It could go either way. Exactly.
It could go either way. It really just depends on what the material is. But just know that if you're going into private equity, that fast-paced adrenaline, things changing all the time, that is going to be a relatively tiny piece of your life, and it's going to be much more big, very long-term projects. Now, it might be the week that you're finally closing the deal or selling the company or taking it private or whatever it might be, but the life cycle of things is going to be much slower.
Yeah.
And yes, there are a lot of different strategies at hedge funds. There are some hedge funds that hold positions for years, but you better believe that those people are watching those positions every single minute of every single day. What we're getting at here is that you might be killing yourself or freaking out and saying like, oh my God, I want to go to PE because I hear I can make so much money. I didn't have the right internship my freshman year in college. My life is over. Please don't feel that way. Because from one second to the next, the industry may shift. B, there are so many opportunities beyond these mega funds that if this is something you want to try on for size, there are at least tens of thousands of private equity firms of varying size and scope that you do have an opportunity to break into. And C, do you actually want this for yourself? You know, you really have to think about that. Rather than being so focused on what the exit opportunities are, think about what you are learning in real time and who you are becoming in real time, especially when you're so young and early in your career.
We hope that you guys found this episode valuable.
Thank you again, guys. We love you. We appreciate you listening, and we'll talk to you again next week.
Thanks, guys. Bye.
Bye.